Hello, passive income pilots. What's happening? We're here today with the Money Insights guys who have become really valuable partners for us, just in terms of setting up my personal life insurance policy. This has been a strategy that we have just I don't know, Ryan, you want to talk a little bit about your experience so far? We want to do a little bit of back and forth before we start the webinar as people trickle in. So if
Well, I
you're
think,
already in the room, thank you for being here.
yeah, no, I think what's been great is I think since we started the podcast, it's really opened my eyes to the additional leveraging opportunities we have to find available cash and invest,
Yeah.
and also get a benefit of a life insurance payout. So I think what we'd like to do today is really kind of provide a workshop where we're saying, okay, we've talked hypothetical, high level on how a life insurance policy works, how we can leverage it, how the different mechanics of this works. But like, what are the details here? Let's pull up a statement. Let's go through a statement. Let's get more
Yeah, let's
granular.
look under the hood.
Yeah, so that way, we've sort of like, to use an airline pilot analogy, we've got the high level checklist, but we're going into the expanded versions of the manuals and really learning the how the inner workings work. And so we wanted to do this for my own personal curiosity. This is kind of a selfish webinar, but also to have our listeners kind of dial in and be able to interact, ask questions, and be just a little bit more hands-on. And then we're going to have this recording available after the webinar on our website so people can download and they can rewatch. And so, you might have listened to the podcast and then kind of went to your spouse and said, "Hey, I heard this thing and it sounds really cool." And he or she might be like, "Well, how does that work?" And then, "Oh, I don't know, but it sounds cool." And then you guys can kind of re-download the webinar and watch how it
Yeah.
actually works and functions. So that was kind of the plan for today.
Really, the focus is going to be on folks who have a new policy because we've gotten some emails saying, okay, I got this new policy. Like, it'd be nice if you guys could do like because they're
Yeah,
talking directly to you, Ron, or you,
Yeah.
Brennan, right? But they're like, hey, if you guys just did an open forum, like, hey, let's crack this policy open and see exactly how it works. So yeah, I'm
yeah,
selfishly looking forward to it as well. So thanks, guys.
yeah. So yeah, and so we wanted to give people a couple minutes to join, but um, you know, I think we just get to the point here. Money Insights provides a vehicle in order for you, provides the platform to you to make a life insurance policy. In the way that I understand it, you can get this life insurance policy. It provides you with a death benefit, but it also provides you with the ability to leverage against the policy and make other investments, which help you then increase the overall yield on those investments because you're basically using money from your policy while your death benefit grows, effectively providing win-win-win for everybody, right? You have this life insurance policy and all that. And if you fly for Delta, you fly for one of the airlines, you might get sort of a payout at the time of death. That's not what this is. This is different. This is in addition to that, and provides more of a vehicle to play with during your career and then benefit from, after your career is over and you're retired and, at the time of death. So
It's really
uh,
just a tool to stuff cash into and then borrow against to make your investments. It's not an investment product. It's a layer, and
yeah,
it's something that you have to be churning. You have to be using it like a bank account in order to make it work. And I think one of the most powerful things that I've taken away from it is the estate planning aspect, is it's a way to transfer wealth from one generation to the next tax-free. That's not really what we're getting into today. You can go back and listen to one of the episodes. But anyway, Ryan and I have talked enough. Rod and Brennan, you want to jump in,
yeah,
give more about your background and kick things off?
yeah. We'll go ahead
Sure.
and get started now.
Yeah. So thank you everyone for joining us for this Optimize Your Policy workshop. I'm Rod Zabriskie. I have Brandon McConnell here with me as well. And we've had a great time meeting a lot of the pilots, kind of a lot of the members of the community over the last year or so. It's, since we started, we became familiar, first showed up on the podcast. And so I think what we want to do today is first I'll have Brennan do kind of a high level overview of the strategy. So if there's anyone coming into this who's maybe want to kind of fill some holes on the strategy as a whole, we'll do high level first, and then we're going to get into really the details. And that's really what we're intending to do, is help people see the nuts and bolts, like how does it actually work in practice. So Brennan, let's go ahead and do the overview first.
Yeah, yep. And I'm excited about this because I do think, we often have clients come back to us and ask us these kind of questions that we're going to walk through today. And they're a little bit more technical questions, right? Talking through, what happens when you take a loan? How do you pay it back? What's the best strategy? And so I think this is going to be super helpful. But before, we get into that, just as a high level overview of the strategy, when somebody's investing in cash flowing assets or alternative assets, they typically have a place that they store capital until they're ready to deploy it into the asset. They want it to be safe, predictable, liquid, and it usually ends up being a checkings, a savings, or a money market account. All we're doing with the investment optimizer strategy is we're replacing that opportunity fund with a much more efficient account, which is a max overfunded dividend paying whole life insurance policy. And so what you do is you capitalize the insurance policy. When you capitalize the insurance policy, you create this bucket of cash value. Now, the cash value is something that you have the ability to go in and take a loan against. Before I go through that, the reason we're using a max overfunded dividend paying whole life policy is because we can get a consistent 5 to 6% return in the policy. It's tax free, so we're not getting 1099 for the year end growth in our money market or our checkings or savings account. And then the biggest reason that people really love is the ability to take a loan against the policy instead of withdrawing the funds. Because when we take a loan against the policy, our entire cash value continues compounding and earning compounding interest, even while we have those dollars elsewhere working for us in a different asset, like multifamily real estate or self-storage or debt funds, right? Anything like that. And so what happens is once we have this policy, we get access to this much larger bucket of money, which is a general account of the insurance company. And when we request a loan, the loan comes from that big bucket of money. And that's a key point, because that means our cash value continues compounding in our bucket. We get the loan from the insurance company. We take that loan, invest it into a cash flowing asset. And then as that cash flow kicks off of that asset, we're just simply going to flow that money back into the policy to repay the loan, not because we have to, but because we want to replenish our opportunity fund so that we can go out and, purchase more assets, create more cash flow and more streams of income.
And just to clarify something right here, we clarified this on a previous webinar, and that is that the opportunity fund is really your savings account, right?
Yes,
not to be confused
absolutely.
with an opportunity zone or some other fund that you're investing in. That is literally just a capacitor of cash, which normally would be just a checking account or a savings account until you have $50,000 or $100,000 sitting in there and you're like, okay, I need to go invest this. And instead you're funneling those dollars into the policy instead. I just want to clarify
when you think
that.
that's a doctor's outfit there, but you can just put an airline pilot outfit out there.
Yeah, exactly.
But yeah, I mean, I think opportunity fund should be just kind of your savings account, right? So where are you putting as a pilot, we've got our 401k contributions. We're not talking about that today. We have our, maybe you have another bucket of money that you invest your taxable dollars into, meaning like you have a JP Morgan account or Charles Schwab, whatever. But then you have this excess cash. Your savings is good. You've got all the money you need in your savings account to weather a storm, a furlough, a layoff, a spouse losing their job, whatever it might be. And then you have this extra money. That's your opportunity fund, right? So that's where you're going to say, I'm going to invest in a Turbine Capital investment, or I'm going to put money with Spartan or whatever it is. I've got this extra $50,000, $100,000. And what we're trying to do is show the mechanics of how you would take that money, put it into a life insurance policy, have it grow, benefit with a death, have a death benefit portion to it, have all the things that Brent just mentioned, which is like it could grow, it grows and compounds. And then when you're ready to make the investment into a syndication or buy that rental property or whatever you're going to do, that is in addition to all the other things you're doing, you're going to do it via a loan. And that's the right-hand side of the screen where you've got that excess cash flowing into there. And that's where you have that. And I just want to take a moment to just pause and just say, you know, we're not giving any tax, legal, or investment advice on this webinar. Do your own due diligence, consult with your own financial person. This is just Tait and I having kind of a down and dirty, just, you know, free-flowing webinar to talk about some of the mechanics. Just friendly conversation. We're not giving any advice. We're not telling you what to do. We're just showing a potential strategy and that you could potentially deploy in your own personal, you know, in your own personal life. So
Perfect. Okay, awesome. So with that kind of backdrop, and again, probably a lot of the people who are on this had some familiarity, especially if you already have your policy, right? We've gone through in a lot more depth and talked through what it looks like and how we set it up. But now what we want to do is talk through the 5 phases of your investment optimizer. Okay. Now the first one is to set up an optimized policy. And again, we've done that. We're not going to spend a lot of time on this one, but I had to leave it there because getting the right structure of policy is critical. And we'll see it. This is going to be peppered in with everything we're going to look at. But I wanted to include that as kind of like an initial start. So next, what we want to do is when we talk about capitalizing the policy, essentially what we're doing is you now have your optimized policy. You're going to be putting money into the policy. Okay. First screen I want to touch on with that in mind is this is a dashboard, and we used primarily Penn Mutual. So this is one of my policies. We're kind of just pulling the curtains back so everybody can see real life. This is my policy as of yesterday afternoon. Okay. And the reason I wanted to do that is because this is what you'll see when you have a policy, you log in on your account, you're going to have this dashboard, which is the kind of breakdown, but then you'll see a little eyeball icon near or next to all of the different sections. When you click on that eyeball, you jump in and you see a lot more detail, and we'll get in. I'll show you some of that detail during the conversation today. But as we talk about capitalizing the policy, the first thing I want to do is look at, if you see on the upper right-hand corner here, we have this Pay Now button. So it just so happens, timing worked out great because my policy anniversary is coming up on March 19th and here in a couple of weeks. So they open up the portal 2 or 3 weeks in advance. Now, I mentioned this is Penn Mutual, my policy is with Penn Mutual. If your policy is with a different company, your dashboard, your interface is going to look a little bit different. But a lot of the same types of information is going to be in there. If you have questions, like you're saying, hey, well, mine's with whatever Mass Mutual or Lafayette Life or some other company, we're more than happy to engage in a conversation and help you if you get stuck on any of the details on this. But anyway, this is what we'll look at here. So we're going to look at so I tap on the Pay Now button, and then this is what I get. Okay, so essentially what I'm doing is I'm setting up an ACH transfer where I'm going to plug in my bank information and initiate money going directly from my bank account into my policy account. Okay, and because of Patriot Act rules, we have to line up ownership of the policy and ownership of the bank account. So I couldn't use one of my business accounts to transfer into my personal policy because the ownership doesn't match up. Okay. So in this case, I own the policy individually. I would be transferring from an individual bank account into the policy because the ownership then matches up. So you'll notice here there are 3 different numbers that already show up. They already plugged those numbers in. The first one, this one that says premium for 12 months, this is what we often refer to as the base premium. And we also, people that we've worked with may be familiar with the term funding range, right? When we set up these policies, we create a lot of flexibility. In this case, my policy, I can put up to $35,000 a year into it. My minimum that I have to put in every year is this $7,600 number. Okay. I have it on annual mode. So I drop that in on the front end. We can switch that into quarterly mode or semi-annual or monthly or something. And then obviously that number would be 1/12 or 1/4 or whatever of that number. But again, that number pops in and I can't change that, right? In other words, because that's the minimum nut I have to crack each year, they already plugged that number in. I'm just coming in to make the payment. Okay. Now you see this next line called the paid up additions rider. And that's the technical term inside of the insurance policy for the bucket that we included to overfund. So when we talk about the flexibility, and again, in my case, the funding range of 7,000 to 35,000, this additional 28 grand that I can put in is going in through the paid up additions rider. Okay. Now you'll notice that this is a field that I can change, right? So if going into the year I say, well, I only have whatever 10 grand ready or 20 grand, I don't have the full 35, great. I just adjust that number to make it be whatever I want it to be for this ACH transfer, and then I can come back in later. I basically have an 11-month window from, in my case, March 19th until February 19th of next year to put as much money into it as I'm going to for the year. Okay. So I can adjust that. They make me put a penny if I'm going to do any, right? So I have this minimum over here, but anyway. And then we have the loan payment. Okay. So in this case, you can see it down here. I have a loan payoff balance of 144,000. If I had that much money, I was ready to pay it off. Great. I can adjust that number to pay off the whole thing. The default number they've dropped in is the interest that's due on that loan for the year. Now, we also often talk about interest with the loans is more favorable than it is with a lot of places like a bank. If I had a line of credit with a bank or whatever. And the reason is because the interest only comes due once per year. My policy anniversary is coming up. That's the due date for that loan. But what's interesting too, you'll notice down here, it also says unpaid interest will be added to the loan balance. And the reason they say that is because even paying that interest is optional. We always recommend people do it because Brennan talked earlier about the difference between paying simple interest on my loan versus earning compounding interest on the cash that's acting as collateral for that loan. And so I need to make my interest payments in order to make that happen, right? But as you'll see here in a minute, if I don't, it'll tack on to that, but I can still come back and pay it later. So for example, if I've invested in something where it has like an annual distribution or something, March 19th may not line up with the distribution. If the distribution comes in April or June or whatever, then oh, great, I don't have to make the payment now. I can come back later and make it up. I will experience a little bit of compounding interest by doing it that way. Or if I had cash sitting in my bank account, I could pay it now and then reimburse myself when the distribution comes later. So a lot of different ways you can approach
I have
that.
some rapid fire questions.
Great.
What is your interest rate?
Yeah. So on this one for last year, for 2024, it was 6.2%.
Is it
For
fixed?
2020,
Or floating?
what's that?
Is it fixed or floating?
It's floating. So for 2025, it's now 5.3. So for the time where this loan was accruing interest in 2024, it was at that 6.2% rate, and then it adjusted on January 1st to 5.
What is the rate based upon? What benchmark?
Yeah, it's linked to a Moody's corporate bond index. So they take
Okay.
like an average over, several month period, and then that's what they do. And I think they can update the interest rate more often, but January 1 is when Penn Mutual
They
updates
adjust.
theirs.
Okay. And when you when it says you can tack the interest to the loan payment, that's going to make your loan bigger.
Right.
And if your loan is maxed out, would it advise you that you can't put the unpaid interest to the loan, or is it an automatic approval that you could put it on the loan every time?
Great question. So it's an automatic approval. However, if I don't have the 7,600 to pay up here, then that's when I have to reach out to Rod and Brennan and say, hey, what am I going to do? And again, you have options. Like, again, I could split it up and pay whatever that is, $800 a month instead of, the 6,500 a month, whatever. So,
Okay. And I think we've kind of jumped ahead because how do you even make a loan in the first place? Are we going to cover that today?
we will. Yep. We'll get to
Okay,
loans.
excellent.
So
Okay.
mostly I just wanted to say, hey, this is what you see when you
Yeah,
log in,
okay.
and we will come back to this view when we get to that point of making payments on the loan.
Excellent.
So, okay.
Right.
Perfect.
Thank you.
Okay. So, again, if I made a partial payment, there's a button I would click later in the year, come back in, see the exact same thing. ACH comes up. The base premium number is not going to show up anymore because I already paid that, but it would have the PUA section there, and I drop in the number I'm ready to pay.
Is this similar to a 401k loan where you're paying the interest to yourself, or are you paying the Penn Life them?
Great question. I'm paying interest to Penn Mutual.
Okay.
Yeah.
See, this is money that is gone.
Yeah, and I think
Yeah.
that's a really good question because I hear a lot of practitioners out there who describe it that way, like you're paying interest to yourself. And so I get that question a lot. The reality is that that's not the case. And I think if they describe it that way because if I'm paying interest while I'm earning interest on the collateral, then it's as if I'm guessing at why they describe it that way because it's confusing to me as to why they would. But that's my guess as to why someone would describe it that way.
Well, and okay, 6.2%, let's say it's five, would you say 5.2% this year? But how
5.3.
much is it growing?
Yeah, great question. So part of that depends on the company you're with. So they have what they call direct recognition or non-direct recognition. All that means is with a non-direct recognition company, the interest rate that I'm earning on my cash value interest and dividend that I'm earning is the same whether I have a loan against the cash value or not. Okay, there's no change in what I earn on the cash value. With a direct recognition company, when I take a loan, the portion of my cash value that's acting as collateral for the loan. So in my case, I have my outstanding loan balance of this 136 has collateral in the cash value of the 136. That portion is earning a different interest rate than the uncollateralized portion that's earning the guaranteed interest and dividend. And so in this case with Penn Mutual, what they do is for the first 10 years, if I'm paying 5.3% on my loan, then I'm earning 0.65 less than that on my cash value that's acting as collateral. The nice thing about that is that moves with the interest, right? It's direct, meaning it's directly tied to the interest rate. So when I was paying 6.2, I was earning 0.65 less than that, right? When it's now 5.3, I'm earning 0.65 less than that. That happens for the first 10 years. When I get past that first 10 years, then it's an exact match. If I'm paying 5.3, I'm earning 5.3. If I'm paying 6.2, if I'm paying 10, I'm earning 10, right? So it moves exactly with it.
So just to make
So
this
the
really
opposite of-
simple, if you're not following along with this, my small brain, you got a loan for $144,000, and that is out doing something for you in your portfolio, and you're paying effectively around a 5 point something percent average annual rate of return. If that $144,000 was in something like a debt fund like ours that is paying 9%, you are effectively making a spread of 3% interest on money that is in here, but you're also benefiting from the cash death benefit and the account growing in size. So you're effectively killing two birds with one stone and arbitraging what you would make. I'm using my debt fund not to like promote the debt fund, but just to give a simple
Good example.
like real world. If you had done this, you have your life insurance policy now, and you've got a spread between paying the 6% call it loan payment and earning income on a 9% debt fund. Now, if you do an equity deal, it may or may not have a distribution, so you just have to like right size that to your personal financial situation. Yeah.
Great point, Ryan. I think it's also really important to understand as well, though, that your adjusted interest rate, because that 136,661 is earning 5 point something percent,
Right.
while you're paying 5 point something percent interest. So it's essentially in the first 10 years, as you said, 0.65% interest loan. And then after 10 years, it's a 0% interest loan because they perfectly offset each other.
Right.
Is that correct?
Right. And then I'm going to go back to this again because this is the critical point. As long as I keep up with making interest payments, I've kept that simple. And especially if I'm paying down the principal as I go, now it's simple interest on a decreasing value. What that means is that I'm paying, when I look at just the pure dollars and cents that I pay in interest, I pay a lot less. Even with that 0.65% difference, I pay a lot less in interest than the interest I'm earning on a compounding basis. So that
Right.
does create an arbitrage for me in my favor.
Of course. That's awesome. Okay. Thank you.
Cool. Okay, perfect. Okay, so let's jump to the next section, which is growth inside. Okay, so now I've put money into the policy. and some of it came out in costs, right? We minimize the cost. We try to make those as low as possible. Um, and then the rest of it goes into the cash value. Once it lands in the cash value and it's growing, well, what does that look like? I touched on this a little bit a minute ago, but as on the baseline, I'm earning a guaranteed interest rate and a dividend. In this particular policy that you're looking at with Penn Mutual, it would be a 3% guaranteed interest rate plus an additional 3% for the 2025, 3% dividend, total of 6% is what they're paying out right now. And again, companies differ and that will adjust from year to year. But across the board, companies right now are paying 5.5 to 6% total between the guaranteed interest and the dividend. Okay. So let's look at my dashboard here again. And this time what I'm going to do is I'm going to tap on the eyeball icon up here for policy values, and we can look and see what that looks like. When I'm looking at the full thing, is a little small for the numbers, but what it does is it breaks out my death benefit, and that comes from a few different places. But at the end of the day, 1.3 million would pay out to my beneficiaries if I passed away right now. Okay. And then what it does, it breaks out the cash value. So one thing that I think is really maybe the most important thing about this view is that when you look at these first two lines, the one that's called guaranteed cash value, that's the portion of my cash value that comes from the pure like whole life portion of it. That $7,600 a year that I'm paying for my base premium is building that guaranteed cash value. I don't know why they call it that. It's kind of a weird name, but ultimately that's where that money is going. And then the overfunding that I've done is building up this paid up additions cash value. And it's the combination of those two. If I'm saying, okay, well, how much do I have in my account at any given time? Well, it's the combination of those two. So what's that, about 256, 257 of cash value that's sitting in my account, okay, growing right now. If I cash it out, they're going to pay off my loan first, right? That outstanding balance, the 136 principal plus the interest that has accrued and is now due. So 144 total. And so if I said, hey, just cashed out, send me my money, they would send me 112, right? But I think, again, I just go back to this. The critical thing is even though I have the loan, even though the net is showing 112, in reality, I have 250 grand in there that's growing for me.
So if you're a real estate investor or you're moving and shaking, or maybe you're going for a home loan and the bank is asking you for liquidity, my understanding is the cash surrender value is really what the bank is after, because they want to know how much cash today would you have if you were to liquidate assets and liquidate your plan.
Yes.
So if
right.
you're applying for a mortgage, I have a life insurance policy similar to this. When I go apply for loans and I create my personal financial statement, this cash surrender value is critical to conveying to a bank that how much cash I have on hand, how much liquidity I have. Yeah.
Perfect. Okay. So I told you we would hit on now the cash growth. Okay. So I have that money sitting in there and what's happening to it. One of the things that if I were to design the portal, I would do very differently is I would make it more obvious what's happening as it grows. As it is, we're tapping into a very traditional vehicle in this kind of whole life insurance policy, and there's not as much visibility as we would like to have. However, we can create that visibility. I'm going to show you how to do that here in a minute. And in this case, we don't have this feature with all the different companies, but Penn Mutual offers, I can see up here, quoted as of 3/3. Again, I took these screenshots yesterday. So it was showing me values as of end of day from the previous day. But I can click on that and it'll show me the calendar. So I can actually go back and select a day in the past and it'll show me what the values were as of that day. So if I go and I say, okay, well, I'm on March 3rd, but I want to look at January 19th. So I intentionally went back 2 months because what happens is I told you my anniversary is on March 19th. Well, on the 19th of every month, I call it the month anniversary, is when the calculation takes place on my policy for the month. Okay. So once a month, they run a calculation that includes any of the costs that are being run, interest that is earned gets calculated at that same time. And so you can see the impact on the cash value. So pay special attention to that guaranteed interest line and the paid up additions line that we talked about earlier. And right here, so about, again, about 254 in there right now, 255. And now we're going to jump to February 19th, and you can see that the numbers went up a little bit. Okay. So again, on February 19th, they ran a calculation. Charges were accrued, interest that I earned was applied. And so you see the net difference of that happening. And then you'll notice there's another line in there that we hadn't touched on earlier, this premium refund. Again, this is only if I'm cashing out the policy, but if I do, I made that $7,600 payment last year at the beginning of the year. And if I cash out mid-year, well, they have to refund a portion of that. So they take 1/12 against my 7,600 every month, so that here I have 1 month left before my anniversary date. Therefore, if I canceled my policy 1 month before my anniversary, they would refund that remaining portion to me. So that's why that additional line showed up there as well. Okay. But in this view, I can go through month by month by month and kind of track those numbers. Oh, this is how much I earned in that month. And I actually had clients who will do that, built a spreadsheet and kind of track that out. Not all of the companies have the feature where I can go back and choose previous dates. So in that case, what I would need to do is just go in once a month and kind of document those to get a feel for what I'm showing here in this view.
Yeah, this
Okay.
is definitely one of the gripes with life insurance is it's hard to understand. You know, it's
Yeah.
200-year-old companies, and they're certainly not building really tech-savvy portals.
Right. Yeah, we're just grateful that we're online with them now. It's it took a little while to get to where we are now, and so we're grateful for the tools we have. But yes, it is the product itself is ancient, which again it's interesting because we choose these companies intentionally because they've been around for a long time, right? We like the stability, 150 years of having paying a dividend or all those kinds of things. But then, you know, it kind of comes with some of that. So, but at the end of the day, here's the thing. When, again, I'm talking specifically about Penn Mutual, between 2008 and 2018, they were paying combined guaranteed interest and dividend of 6.34%. So what was really cool about that is I was able to have an illustration in front of me, see what the projected values were at the time of a policy we set up, say like in 2011 or something, right? 2012. And then track year by year by year for the next 6 years because the dividend didn't change. And it was within pennies of what the illustration said. So what I want to try to do is take what is or has less visibility, maybe not as much transparency as we would like to see, but break it into a more understandable way to do this. And so, because what I can say definitively is, if the company's paying out that guaranteed dividend or that guaranteed interest and that dividend, you're earning that, right? And here we can kind of see the effect of it happening. But my point really is just to say I've been in this long enough. I've looked at it long enough, my own policies with a lot of other people's, and I can say the company's not telling you they're going to do one thing and then doing something else. They're applying that guaranteed interest, 1/12 of that each month as we go, and then the additional dividend gets tacked on at the time of your anniversary. So that portion we're not seeing month by month. In my case, on March 19th, they're going to go in and tack on my dividend for the year.
Stuff.
Okay. All right. So so that's where I wanted to show you my transaction history, just so you can see where that's happening. So if you look here, you go back to 2 years ago, I made my premium payment. Here's where it's showing I took a loan. I didn't get the interest paid on my anniversary date. I made my next payment up here, so I had about a month's worth delay before paying that. But again, it worked. I didn't incur any additional fees or penalties by letting the interest accrue like that.
It just
Just
gets tacked
on.
to the
Yep.
balance.
Tacked onto the loan balance. And then when I made
That's
the
a lot
payment, then
different
it
than
got paid down.
how it works with a bank. You have to
Exactly.
pay the interest to a bank.
Yeah. Yeah. You can't miss it. Right. Um, and then, but then, you can see where I made my payment here. And here's another kind of, I think really cool nugget. A lot of people get stressed out about, oh man, March 19th, my anniversary's coming. I have to make sure I make my payment before then. And that's great. If I can do that, great. If not, in this case, I didn't make my payment until the middle of April. But do you notice the effective date on that? They dated it as if I had made the payment on March 19th.
Which one?
So, and I have a 60-day grace period. That doesn't go on forever. At least for that $7,600, that's the minimum, the kind of the base that I have to make sure I'm covering that nut. I have a 60-day grace period on making that portion of the payment. So,
A little bit
okay.
of interest is the point, right?
Yeah, they're backdating it, and I earn it as if I had paid it on March 19th.
Nice.
Yeah.
Is that a Penn Life thing, or is that like generally how it works?
That's there. If I waited the full 60 days, they're probably not going to go back 60 days. But I think for Penn, it's a month. So if within the 30 days of the anniversary date, then they will backdate it as if it was paid on that date.
And just for people, I don't know, maybe this is too basic and not applicable to the workshop, but you guys, Brandon, Rod, you're going to go out and you're going to find your client the best policy and shop the market. So one might be Penn Life, one might be Northwest Mutual, maybe, or Principal, or whoever's selling these. Maybe I'm off on those, but
yeah, no, there are about 10 or 12 different companies that we're always keeping up on. And
so the applicability of paying late and getting it backdated may be a Penn Life thing. It might not be a, hey, you always have a 60-day grace period, or do you always have a 60-day grace period?
60-day grace period is pretty standard.
Okay.
Must be like a regulation or something, because they all do offer the 60 days.
And you're picking the best plan for people based on like what the market is trading at that time that the client is sitting in front of you requesting a plan, right?
Yes.
Okay.
Yeah. So we're keeping up with those. And when I say 10 to 12 companies, we want mutual life insurance companies because they pay a dividend. So we're picky on that. But again, we're only wanting companies that have been around a long, long time. And so we're always keeping up on the products that those companies offer, so we can be making sure we're giving the best available option.
Yeah. So I went to Northwest Mutual, right, years ago. I probably limited myself in the competitive nature of the process that you run to pick the best plan that's trading at the time. Is that a fair statement?
It is. Yeah. I would say they're around number 7 or 8 on the list. If I were ranking all of the different products right now, again, I don't know about the time when you were doing it, but.
Yeah. So no competitive process was run in my regard. So I don't know if I had the best plan that was offered at the time that I took it, because I went direct to a company. So anyway, I don't want to digress too much in the workshop, but I do have selfish questions as I go through this.
No, this is great. Yeah. This is great. Okay. So the next thing I want to do is I've shown you what's happening in the portal. Now I'm going to show you the statement. So again, they're old school. They're going to mail you once after your anniversary. So here in 3 or 4 weeks, I'll get a letter in the mail that includes my statement. But
hey, Rod, real quick.
Yeah.
Are you going through the dividend as well? Because I was just going to mention the dividend getting paid out there. Because we did the guaranteed interest, and I just wanted to touch on how the dividend.
Yeah, let's go for it.
Yeah, so I mean, very simple. The guaranteed 3% gets paid out just like Rod told you, right? They take that 3%, divide it by 12, and pay it monthly. The dividend, on the other hand, so in this case, the dividend at Penn Mutual's just got changed to an additional 3%. And that dividend is getting paid out at the anniversary date every year. So once annually, you'll see that dividend paid up additions. There's 2 of those on March 19th, the 4,036 and then the 114. That is the dividend getting paid out to Rod's policy annually.
Yep, exactly. And that for whatever reason, there is more visibility. Like you see a line item on that one that's earned here, and then I'll show you it again on the statement. They'll kind of spell it out there as well. Okay, yeah, great point. Okay, so I talked about how they mail out the statement. I think it's all of the different companies. They'll also post a link on your portal where you can view that. And so in this case, this is in the correspondence section of that dashboard that we showed you. You'll notice up here it has all of year by year, all the different stuff. I can go back to the beginning of my policy and see all of the documents associated with it, going back to the beginning. And so here I have my annual statement. So in this case, it's from last year because I don't have it yet for this year. So that's what we're going to look at here. So I picked out some the most important sections here. They're breaking out. So here again, this looks familiar, right? This is a lot of the information we saw on the online portal. And so it's just taking a snapshot in time. On the anniversary, these are what the values looked like. And so you notice that they're different, right? Total net cash value. Well, on the other thing, it showed 114, right? Well, I hadn't made my payment yet for the year. I hadn't made my loan payment that I made during the year. So so again, this goes back to my statement from last year, but the point is that it's just taking a snapshot of all of those values and kind of breaking out the different pieces in, premium payment made, dividend earned. So here's that total amount that I earned on the dividend. And then on the second page is not loading. It shows a breakdown of, okay, that's weird. It shows a breakdown of the different values. So again, basically like what we saw in the online portal, breakdown of the death benefit in all those different categories. So let me actually go back to this view here, basically showing this same kind of thing in your statement. So you, if you're someone who still, stores paper files, then you just put those statements in and you can review year by year. Hey, here's what it looked like as the values changed over time. Okay. All right. So let me jump back forward. Okay, so now we're talking about accessing the funds through the loan. And this one it's a little more simple because now that you know and you can see, hey, here's the money that I have in it. And I'm going to jump back because you may have noticed on that view that down here, it shows what I have available as a loan at this moment, this very moment. It also shows what the interest rate is on that loan. So I have that, I can get on and I can see that anytime. Okay. And again, that's my net available amount, takes all of everything into account, the loan I already have, cash value that I have, etc. So here's what the process looks like. When I'm ready to take a loan, you reach out to our office. Patty in our office is the person who processes the loans. She will send you a form for an electronic signature. She submits that to the insurance company. From the time it's submitted to the point where that money lands in your bank account is roughly 7 to 10 days. It can happen sooner, but for planning purposes, plan on 10 days just because with holidays or whatever, sometimes it takes a little longer than other times. So, okay. Now that money's in your account, you go use it for whatever you want, right? And the biggest thing I want to point out here is that's the process. You don't have to go in front of an underwriter and explain to them what you're doing and justify the use of the loan or whatever. Your money sitting in your account is justification, all the justification they need. They process it, they send you your money. Now you have it, you're using it for whatever you want. Okay. So that one's a lot more simple. It's when you want your money, when we talk about it being liquid, it's liquid. Again, you have to plan ahead a little bit as far as time to get the money into your account, but as long as you do that, you're in good shape. Okay. All right. So now let's talk about. Oh, go ahead. Did you have something, Ryan?
I have a really dumb question, and maybe this shows how well I'm absorbing the information or not. But if I took a loan today from my plan and I did absolutely nothing with it, and it just sat in a savings account collecting dust, how much money would I make on it or lose every month? Is it the spread that we talked about earlier about?
Yeah, it would be the spread in that case. So if you're
Okay.
earning at least 0.65% in your savings account, then you're breaking even.
Okay.
But,
Okay.
That's
So
a really good question.
just to be abundantly clear, like you could open up a plan, reborrow the money, and you're only losing a half a point. And when I say only, I don't want anybody to lose 0.65 in Rod's plans in the specific example that we gave.
And that would be versus if you didn't take the loan, you'd be making 5.3% on the money if it just sat in the plan.
Right.
That's why we talk about, it doesn't make sense to stuff money into this plan if you're not going to go use the money for something, because I think everybody can agree you could do better than 5.3%.
Yeah.
The S&P.
But just to like, again, simplify all these technical terms. You're going to have a death benefit. You're going to have dividends. You're going to make money on the money that the excess, you've taken care of all the things in your life. You've got some extra cash for buying into this policy. Like you're going to make great income on this and then have the ability to call it back, some of it back, and then go place it into something that makes it 10, 20, 30% returns. While the other part of the policy grows. I mean, this is I probably talk to 2 or 3 investors a day that are using this strategy to fulfill their, to invest in alternatives like real estate. It's pretty it's actually kind of funny how much more popular it is than I thought it was. And I'm just sort of waking up to it over the last year, admittedly. So pretty exciting.
And you gave the example of that 9% fund that you have.
Yeah.
When we've plugged that in and we just kind of play out the scenario, hey, I took the loan, I received my 9%. In the example I ran, I kept it in there for 15 years, taking the interest payments back, using them to pay towards the loan, building that back up. But in the end, what ends up happening is I was showing an additional 3% above the 9 that you were earning there. So it turned your 9 into 12, just by the fact that you ran it through the policy to make that investment.
Instead of using cash.
Yeah.
Yep.
And don't forget, when you die, people are going to get a bunch of money that you care about. Right. So
yeah, and that's
like
that
to me is like I want to do that anyway. Like I want to have estate planning for my time of death that outstrips, the payout that Delta gives at time of death, which I think is like the highest annual salary or something on a wide body, or I can't remember exactly what the contract says, but this is for real. Like this is actually going to be something that is going to be able to take care of your family. I mean, what Delta does is very generous, but you want to augment that with something else, especially with the incomes that we're earning and the lifestyles that we're designing and living out. Like this is something that you'll want to have in your back pocket. Again, just friendly conversation. So
perfect. No, I'm glad you brought that up, because we're so focused on talking about the investment side of it and all that, which rightfully so, right? That's the whole kind of purpose behind the strategy. And yet that's insurance you don't have to pay for any other way. You're getting that 5% net return in your policy, even after it paid for the insurance, right?
Sense. Yeah.
So, cool. Okay. So last thing we're going to talk about is paying back your loan. And so I'm going back to this screenshot because here we have the option. Again, it's optional. I can decide how much I want to do, but to pay the interest or I could pay additional. So I just change that number. If I have, again, in the screenshot you saw earlier, I paid 27 grand toward it because that was what I had received in distributions back from the investment I was using. And so that's how that payment went in. We often get a question. So sorry, before I go to that, it's pretty simple, right? You make an ACH payment. I can decide how much I'm going to pay, when I'm going to pay. It's completely up to me. There is also an option with most of the companies where I can set up an auto draft. So if I know how much I want them to take on a monthly basis, I can say, hey, just pull whatever, 500 grand or 500 a month out of my bank account every month without me having to do anything. And I can set that up as well.
That's what I have. So I have, Penn Mutual with you guys, and it just automatically comes out of my checking account on a monthly basis. 5,000 goes out. So I was actually curious, how do you switch back and forth between that and a every quarter or every 12 months.
Yeah,
you
so
manually.
just contact us. So Patty would help you set up that monthly draft. And then if you need to change the amount, send a quick email. Hey, instead of 500 a month, I want to take 800 a month or whatever, 200 a month. And then she can get that change done for you. Or if you're saying, hey, let's turn off the monthly, I'm just going to do it, incrementally as I have the money, then she can have them turn that off for you.
Understood.
I keep saying Patty does that. That's really a service that we offer for our clients. You can go directly to the insurance companies. I don't want to make it sound like you couldn't. We just don't think people want to. We offer that. We figure people would rather work with people they know and don't not have to go through the kind of the red tape or whatever of the company. So
I have a question. How do you keep track of all these loans? Because there is, the strategy of layering on multiple policies. I currently have one. I'm planning on adding more. I talked to somebody the other day that has 27 on
Okay.
their personal name. How do you keep track of all these? Once you get 2 to 3 to 4, how do you keep track of all the loans that are coming in and out? Do you have any personal systems?
Yeah, great question. So, number one is we help with that. So Patty again, she's often communicating with our clients and they say, hey, what's my total loan amount available? They could log in and look at all of their different policies. They have access, but they can also send us an email, and so we can help with that. But when it gets to 27, that probably gets a little unruly and would take maybe building out a spreadsheet or something to do that. Or I don't know anymore because my understanding is Mint went away, but there are some of these aggregating financial apps, and these insurance companies, a lot of them are tapped into that as well. So you could have that visibility of your policy on an aggregating financial tool as well, and potentially be able to get that information on a summarized view as well. So
I can tell you I use Monarch and it does not work on Monarch. So if
okay,
anybody's using that, Penn Mutual does not, unfortunately, does not plug in.
gotcha. Yeah. Okay. Well, so on this topic, the other question that we often get is, like in this case, let's say it's me here, and let's say I have 20 grand, right, that I'm going to pay. People will say, well, how do I know where to put it? Right. So here's my priority. Number one, cover the base premium, right? That's the minimum nut I have to crack each year. So I'll put towards that. So in my case, 7,600 of it goes towards that. Second is I want to make sure and pay the loan interest. We've talked about if I keep that simple, then I create an arbitrage. So if at all possible, I want to pay that interest each year. So in my case, it was about 8,300. So now I have whatever, 16,000 of my 20 is going towards those two buckets. And then, okay, well, what's next? Should I make more payment toward my loan, or should I put more towards the paid up additions rider? My kind of analysis I've looked at is to do it towards the paid up additions. And the reason I say that is because every time I put money into that bucket, the bucket gets bigger. Even if I'm going to loan against that money immediately, and I've done this, right? I had 50 grand came to me. I knew in 6 weeks I was going to be investing, and I knew exactly where I was going to invest it. I dumped it into my policy first, increased the size of my bucket, and then took a loan and went out and did the investment. Okay. So that's where I would put it first. And then let's say it wasn't 20, let's say it was 50,000 that I had ready to put in. Then I would cover the base, pay the loan interest, pay towards the paid up additions. That puts me at about 43,000 total. And then the other 7 I would put towards the principal of the loan.
Makes sense.
Okay. So now this is if you're in growth mode, investor mode. When I get to the point where I feel like I'm within maybe 2 or 3 years of hanging it up, right, living off of my investments instead of continuing to work, then I'll reverse 3 and 4. I want to refill the loan and make it available for tax-free income in retirement. And so that's how I would change the priority when I get to that point.
Can you show us the that payment page again and where those dollars would go into what boxes?
Yep. Yep. So again, this one is the 7,600 is already filled in
Fixed.
for me. In that case, if I had the 20 that I was putting in, 76 plus the 83 puts me about 16. So I would just change the paid up additions rider number to the 4,100, whatever it would be, to get me exactly to the 20 that I have to pay. I see that total down here. I drop in my bank information and I make the payment. If it's
But
the
you would
50,
shove more money into the loan payment and you would take your paid up additional rider down in order to prioritize the loan repayment.
exactly. Yep. I would revert if I was in that kind of later time period, then I would just reverse that. If
Got it.
it's showing here, I can do up to 144 towards the loan. That's the loan payoff at this moment, right? So, so I know what's the max I can put in there, and I can choose anything between 0 and that number, just based
Very
on
good.
those priorities.
All right. Ryan, I know you have to exit at the top of the hour. What do you got here before we jump to any Q&A from the audience and wrap up with how to get in touch with these guys?
I got nothing.
Yeah, this has been great.
Yeah, this is really helpful.
Okay. So we do have our ebook. So you can use that QR code to download that. I'm actually going to put in the chat a link to get on if you want to schedule something with us. And that offer is open to anyone for any reason. If you've been listening to this and you say, oh, well, my policy is with XYZ company, it's going to look a little different than this. I'd really like your guys' feedback on that. More than happy to jump on that call and walk through it
And
with you.
Rod, I think I'll be taking advantage of that offer.
Okay. Yeah, please do. Please do.
Because I've had a different experience with my contact there kind of freaking out that I'm borrowing the cash, but maybe he doesn't quite understand my whole picture.
Gotcha.
You know, of using the cash to invest or run my business or whatever it might be. So I want to just make sure that it's working. So
Yeah, I'm more than happy to do that.
what Rod is saying is he will pop the hood on a plan that he has not sold you, right? Let's just be
Yeah,
direct.
absolutely.
Like that's a very knowledgeable, that's a very appreciative and valuable resource on someone to kind of help you get your arms around something that, you know, is not even in your, and that's why we want to work with Money Insights and why we brought Money Insights back to the show many times and have these webinars, because we want pilots to really understand the options here, but then also have someone knowledgeable to work with who's not just in sales mode, right? Because like, I mean, Rod and Brent are both like, you know, just talking about how it works and the functionality, and there's not any, you know, overselling of anything on this. And that's what we really appreciate, is just like, this is just pure education. So, which is what we want in the aviation community. So
Absolutely.
super helpful.
And if anybody doesn't realize this, we met at the Anderson Advisors Tax and Legal Summit, and just a wealth of knowledge, and asked you guys to kind of come into the community, because I've said it on the show before, I walked away from $30,000 on a policy that was built wrong. So if I can help anyone else avoid that mistake, avoid losing money, we're doing a great service to our listeners in our community. So thanks, guys.
There is a
Yeah,
So it looks like we have one question that came in. Do we have just
Please. Yes, absolutely.
So David's asking, the annual minimum needs to be paid within a small window, but the PUA are optional and can be added throughout the year. What are the pros and cons to funding the PUA early versus late in the year? Brennan, do you want to take that?
Yeah, essentially the pro is if you get the PUA early in the year, you're earning compounding interest on those PUAs throughout the year, so you get the full 12 months. And then the cons, obviously, you know, you're not earning that interest. But it's nice to have the optionality where you know, if you don't have that capital right away to fund in, again, it's nice that you have the ability to fund that over time or in chunks. So if you get 10 grand or 15 grand here or there throughout, you know, your year, you can just plug that right into the PUAs as you go. Which if you're not going to do it all in one lump sum, that's typically what we suggest. Once you have, you know, 5, 10, 15 grand where you're ready to start plugging it in, get it in as soon as possible, because you do start earning that compounding interest as soon as those dollars enter the account.
A lot of sense.
Perfect.
Brennan. Yeah, and I think that I need to talk to you guys about changing from the 5,000 a month, because, you know, my income is lumpy, and, you know, it's always nice to know that you don't have to put that 5,000 a month in. You throw $15,000 a quarter in instead, and that sometimes de-stresses it, or whatever it is. So thanks again, guys.
Perfect.
Anything else before we hop off?
I'm good.
All right. Thanks everyone for joining. Appreciate you taking the time. The replay will be available and we'll post it in the group. So cheers everyone, and reach out to these guys for questions.